While you were sleeping, the Takaichi Trade just unraveled, not as a headline, as math. For years, the bet was simple: borrow cheap yen, buy risk assets abroad, and let near-zero Japanese yields keep the whole machine calm. That machine just hit a structural breach. As I'm recording this, it's January 26th, 2026, and the time is 10:00 a.m. Drop a comment with what time you're watching and where you're watching from, because this is a global liquidation story, not a local one. Also, quick note, a huge chunk of people watching aren't subscribed. If you want clean, real-world market breakdowns without the noise, hit subscribe. This 90-day window is where the big moves happen. Today we're doing 3 things, fast and clean. First, what actually broke in Japan's bond market, using the prints that matter. Second, why that break forces a sell-off in risk assets, tech, crypto, and emerging markets, even if nothing new happened in those markets. Third, a liquidation guide, the 3 phases that tend to unfold over the next 90 days, and the signals that tell you which phase we're in. Let's start with what broke. Japan's bond market didn't wobble. It breached. The 10-year JGB yield has surged to about 2.38%. The 40-year is above 4.25%. In bond market language, this is not a normal move. This is a passive structural breach, a level change that forces balance sheet actions even if nobody wants to act. Because Japan is not just another bond market. Japan is the world's largest creditor nation. It holds over $3.5 trillion in foreign assets, and a huge slice of that sits in the West. U.S. Treasuries, U.S. credit, and the biggest, most liquid tech names on Earth. For 20 years, Japanese whales, banks and life insurers, bought foreign assets because domestic yields were pinned near zero. That trade worked because the cost of money in Japan was basically free and the volatility was controlled. But when JGBs start paying 2.4% plus again, the logic flips. Suddenly, the best risk-free return for Japanese institutions is at home. Suddenly, the currency risk matters more. Suddenly, the hedge costs change. And suddenly, the carry trade becomes mathematically impossible for a large chunk of leverage players. That's the core idea. The trade didn't end because of a mood swing. It ended because the spread collapsed. Now here's the part most people miss. When a bond market reprices this fast, it doesn't stay in bonds. It hits collateral. Think of the carry trade like this. You borrowed in a currency that paid almost nothing, then you bought assets that paid more. The profit was the spread. The danger was always the same. The spread can disappear in a single week, and the currency can move in a single night. If you borrowed yen to buy US stocks, you have 2 risks: price risk in the asset you bought, and currency risk in the yen you owe. When USD JPY is falling, around 148 and dropping in today's print, the yen is strengthening. That means your loan is getting more expensive in dollar terms. So even if your US stock position is flat, your debt is rising. That's a squeeze, and squeezes don't ask permission. They force sales. So what gets sold first? Not the assets you hate, the assets you can actually sell. That's why liquidations hit the same targets over and over: US megacap tech, Bitcoin and high beta crypto, and emerging market equities that benefited from cheap global funding. Those are the most liquid chips on the table. In a margin event, liquidity is the asset. Now connect this to Japan's side of the balance sheet, because this is the real trigger. Japanese insurers and banks are sitting on large domestic bond portfolios. When yields spike, those bond prices drop. That creates mark-to-market losses. And when those losses build, institutions have to rebalance, raise cash, and reduce risk. They do that by selling foreign winners. It sounds backwards, but it's how financial systems behave. You sell what's up to cover what's down. So the Takaichi Trade is unraveling in 2 directions at once. Leveraged funds are forced to unwind yen short positions, and Japanese whales are forced to repatriate capital to plug domestic holes. That's why this looks like a $20 trillion liquidity trap. Not because one entity sells $20 trillion tomorrow, but because the global system has been priced around one assumption: Japan stays pinned. When that assumption breaks, everything built on cheap, stable funding has to be repriced. And repricing is another word for forced selling. Now let me make this visual. When Japanese yields jump, the incentive changes overnight. A Japanese institution looks at a 2.4% JGB at home versus a foreign bond or a foreign stock that now carries currency risk, hedging cost, and headline volatility. The decision becomes, why am I taking extra risk to earn a similar number? So they pull money back. Repatriation. And here's the kicker. Japan doesn't have to sell everything to move everything. When the biggest creditor nation shifts even a small percentage of its foreign assets, the marginal buyer disappears. The market doesn't move on totals, it moves on the margin. That's why US yields can rise even if US investors are still buying. That's why tech can drop even if the company reports good numbers. That's why crypto can crash even if nothing changed in the protocol. Funding stress beats fundamentals in the short run. Now I want to get practical. Here's the liquidation guide. 3 phases. Phase 1, repatriation, days 1 to 30. This is when Japanese institutions start by selling US duration, often US 10-year Treasuries, because it's clean, liquid, and immediately reduces currency hedged exposure. The symptoms are simple. US yields creep up in sympathy, even when the local data is quiet. Auction demand looks softer, and the curve gets jumpier. If you see US yields rising on days with no obvious catalyst, that's often the plumbing talking. Phase 2, margin calls, days 30 to 60. This is where the stronger yen turns from discomfort into a forced unwind. Funds that rode the carry trade hit maintenance margin thresholds. They're not asked politely, they're forced. And forced sellers don't negotiate prices, they dump. This is where you tend to see sharp downdrafts in mega-cap tech, violent breaks in crypto, and sudden risk-off moves in emerging markets. You'll hear people say, why is everything falling together? That's phase 2. Correlations go to 1 because liquidity becomes the only objective. Phase 3, the floor, days 60 to 90. This is when global liquidity dries up. The idea of a guaranteed backstop, what traders casually call a put, stops functioning as an assumption. Volatility stays elevated, and markets stop snapping back the way they used to. In this phase, the market is not trying to go down forever. It's trying to find a clearing level where leverage can survive. And the key question becomes, does Japan stabilize its bond market, or does it let yields stay high? I'm not here to narrate intentions. I'm here to map consequences. If yields stay high, repatriation pressure persists. If yields are capped, currency volatility becomes the transmitter. Either way, the unwind doesn't disappear. It changes form. And yes, you can see the contagion already. Even in tiny numbers, US 10-year yields are creeping higher in sympathy. Not because the US suddenly changed overnight, but because Japan has been a giant marginal buyer for years. When that buyer steps back, every auction clears at a slightly higher yield. Slightly higher is how big systems break. A few basis points becomes a few tenths, and a few tenths becomes a full percentage point when dealers get stuffed. You also see it in the equity risk premium getting squeezed. When bonds offer more again, stocks lose their free pass. The gap between risk-free and risky compresses, and investors start asking a brutal question. Why am I holding a long-duration stock at a rich multiple when a government bond is finally paying me? This is why a JGB move matters to a Western viewer. Global rates are connected by arbitrage. If the world's safest big bond market reprices, every other long-term rate gets pulled. That feeds into mortgages, corporate refinancing, and any business model that survived only because money was cheap. You don't need to predict a collapse to understand the pressure. You just need to understand sensitivity. When the benchmark moves, everything priced off the benchmark moves too. And here is the most important concept, duration shock. When yields jump after years of being pinned, the time value embedded in portfolios gets repriced violently. Long duration assets, whether it's a 40-year bond or a growth stock whose cash flows are far in the future, feel it first. That's why this liquidation tends to punch the same places: tech, crypto, and anything that lived off cheap funding. So if you're asking, why now? The answer is simple. Japan's anchor just snapped, and the whole boat is rebalancing whether you like it or not. When liquidity gets thin, markets gap on air. One order becomes a headline. One failed bounce becomes a cascade. So, track the phases, and don't let a calm afternoon trick you into thinking the unwind is over. Now, let's make this painfully clear for anyone holding risk assets. This is not about whether Nvidia is a good company. This is not about whether Bitcoin has a future. This is not about whether emerging markets are cheap. This is about the funding layer beneath them. If the funding layer is stressed, great assets can still get sold because the market sells what it can to raise what it needs. So what should you watch daily to know where we are in the guide? 1. The 10-year and 40-year JGB yields. If they keep pressing higher, the breach is still active. 2. USD JPY. A fast drop means yen strengthening, and that means the squeeze intensifies. 3. US 10-year yields and auction metrics. If Japan sells, the US loses a major buyer at the margin. 4. Implied volatility in FX and rates. When that jumps, hedges get expensive and liquidations accelerate. 5. The behavior of mega-cap tech. When the collateral gets hit, it tells you phase 2 is near. Now, a quick ranking of what usually cracks first when the yen's squeeze bites. First, the highest beta, most levered corners, think frothy crypto and momentum names. Second, the clean collateral basket, the biggest tech names that everyone owns and everyone can sell. Third, emerging markets and anything funding sensitive, because the same cheap yen that inflated them is now being reversed. And notice what doesn't crack first, the narrative. The story changes later, price changes first. So here's how people get trapped. They watch a chart, they see a dip, and they assume buy the dip is a law of nature. It's not, it was a regime. It worked in a regime of stable funding and fast liquidity. When funding flips, the dip can keep dipping because the seller is not choosing. The seller is being forced. That doesn't mean everything goes to zero. It means timing and size matter. If you're investing, ask one question. Can I hold through a forced seller cascade without needing to tap this money? If the answer is no, reduce size. That is not fear. That is discipline. Now, let me give you a framework that keeps you sane. 1. Accept that nothing trades in a straight line. 2. Separate digesting from breaking. Digesting looks like higher lows, volatility cooling, and dips being bought faster. Breaking looks like failed bounces, down gaps, and a market that can't reclaim levels it used to hold. 3. Don't marry one outcome. There is a path where the unwind is sharp but short. There is a path where it becomes a slow grind of persistent selling. There is a path where it pauses, then reaccelerates after a calm week tricks the crowd. Your job is not to guess perfectly. Your job is to survive the ugly path, and here's the twist that catches people. The most dangerous moment is not when everyone is panicking. It's when the market looks calm again and people assume the window is over. Liquidations often come in waves. Wave 1 shocks you. Wave 2 convinces you it's done. Wave 3 is the one that breaks complacency. That's why I keep calling this a 90-day story. Now, one more practical idea. When you see a funding unwind, watch the spread between what people want to own and what they are forced to sell. In a squeeze, the best assets can fall the most in the short run simply because they are liquid. Later, quality reseparates. First, everything gets thrown overboard. So if you see violent selling in the highest quality, most liquid names, don't confuse it with a permanent verdict. It can be a balance sheet event. There are 2 crowds in this event. Crowd 1 is the carry trade crowd, leveraged, fast, and sensitive to currency moves. Crowd 2 is the balance sheet crowd, institutions that move slower but move bigger. When both crowds sell at the same time, you get the ugly candles, and ugly candles are not a sign the world ended. They're a sign leverage is being reset. So if you want to stay smart, here are the rules. Rule 1, don't build a plan that requires low volatility. Rule 2, don't use leverage unless you can survive the yen moving against you quickly. Rule 3, separate your long-term thesis from your short-term position size. Rule 4, watch the pipes. Yields, FX, auctions, not the opinions. Rule 5, keep optionality. In a liquidity trap, the ability to wait is a weapon. I'll leave you with the cliffhanger. The Takaichi Trade didn't unravel because someone said a sentence. It unraveled because yields crossed a line that forces repatriation and forces unwinds. And the next shock won't announce itself politely. It will be a single print, JGBs, USD, JPY, or US yields, that triggers the next wave of forced selling. Comment your time zone and tell me if you want to follow up on the 3 signals that confirm Phase 2 has started. This is educational content only, not financial advice. Do your own research and consider your personal situation before making any decision.